Secrets of Sand Hill Road by Scott Kupor. Introduction. Imagine this for a moment. You're 9 months into building your dream company. You and your co-founders, Mark Andreessen and Ben Horowitz, names that would one day become legends in Silicon Valley, have been working tirelessly. You've just pulled off something incredible. You've raised $120 million for a company that isn't even a year old, at a valuation of over $800 million. Think about that. 800 millions. For an idea, a team, and a handful of early customers. The year is 2000, the height of the dot-com boom, and you feel like you're on top of the world. So, you gather all your employees for an all-hands meeting. You're beaming, ready to announce this monumental victory. You share the news, expecting cheers, applause, a standing ovation. But instead, a hand goes up. A young engineer asks the first question. And it's not what you expect. He doesn't ask about his stock options. He doesn't ask about the company's future. He looks at you, with genuine curiosity, and asks, "How come you didn't get a billion-dollar valuation?" In that single moment, the entire world of venture capital is laid bare. The pressure. The expectations. The strange, almost mythical numbers that define success and failure. Another company, a competitor, had just raised money at a billion-dollar valuation. And in the eyes of this young engineer, you had already fallen short. The man who had to answer that question, and navigate the wild ride that followed, was Scott Kupor. He was there, in the trenches of that company, LoudCloud, which would go on to face the dot-com crash, reinvent itself, and eventually be sold for over $1 billion. Years later, he would find himself on the other side of the table, as the managing partner of one of the most powerful venture capital firms in the world, Andreessen Horowitz, or A16Z, the firm he co-founded with those same partners, Mark and Ben. He has seen this game from both sides. He's been the entrepreneur, pitching his heart out, and he's been the investor, deciding the fate of thousands of startups. And in his book, Secrets of Sand Hill Road, he pulls back the curtain on this mysterious world. This isn't just a book for people who want to start the next Google or Facebook. This is a guide to understanding the engine of modern innovation. Venture capital is the fuel that powers the technology that shapes our lives, from the apps on our phones to the breakthroughs in medicine. Yet, for most of us, it's a black box. A secret club with its own language, its own rules, and its own hidden incentives. Today, we're going to open that black box. By the end of our time together, I promise you, you will understand the secret language of venture capital. You will learn why a VC might turn down a profitable company, why they seem to only hunt for mythical unicorns, and what they are really looking for when an entrepreneur walks into their office. You'll understand the delicate dance of power, money, and control that happens behind closed doors. This is more than a summary. This is a masterclass in the art of the deal, from a man who has mastered it. So, whether you dream of building a world-changing company, becoming an investor, or simply want to understand the forces shaping your future, you're in the right place. Let's begin. Book summary. To truly understand venture capital, we have to start with a simple, almost surprising truth. Venture capitalists are not investing their own money. This is the first secret, the one that explains everything else. It's the key that unlocks the entire puzzle. When an entrepreneur walks onto Sand Hill Road, the famed street in Silicon Valley where many of the top VC firms reside, they aren't just pitching a person, they're pitching a promise that person made to someone else. Think of it like this. Hundreds of years ago, Queen Isabella of Spain gave money, ships, and supplies to an ambitious entrepreneur named Christopher Columbus. He had a wild idea: to sail west to find a new trade route to the East Indies. Most people thought he was crazy, that he would sail off the edge of the world. It was an incredibly risky venture. But the potential reward, a share in the riches of a new trade route, was astronomical. In this story, Queen Isabella was the first venture capitalist. She wasn't risking her own life on the voyage, she was financing the entrepreneur who was. Today's VCs are like Queen Isabella's agents. They manage money for large, institutional investors called limited partners, or LPs. These aren't just wealthy individuals. They are university endowments like Yale and Stanford, trying to fund scholarships and research. They are pension funds, managing the retirement savings for teachers and firefighters. They are foundations, working to cure diseases and support the arts. These LPs give their money to venture capital firms for one reason: to generate alpha, returns so high that they dramatically outperform the stock market. A university endowment can't just put its money in a simple index fund and hope to keep up with rising costs. They need to fund a few risky voyages in the hope that one of them discovers a whole new world. And that brings us to the second, and most important, secret of venture capital: the power law. Imagine you're a baseball scout. Your job is to find players who can get hits. If you sign 10 players, and 5 of them become decent hitters, getting a hit about 3 out of every 10 times at bat, you'd be considered a pretty good scout. Your batting average would be .500, which is fantastic. But venture capital isn't like that. A VC isn't looking for a team of decent hitters. They are looking for one Babe Ruth. Here's how the math breaks down in a typical venture fund. Of 10 companies a VC invests in, 5 or 6 will fail completely, returning nothing. 0. 2 or 3 will return a little bit of money, maybe breaking even. These are the singles and doubles. They don't really move the needle. But 1, maybe 2, will be a home run. An absolute grand slam. This single investment won't just make a little money, it will return 10x, 50x, or even 100x the initial investment. This one company, the outlier, has to pay for all the other failures and still generate enough profit to deliver those incredible returns the LPs demand. This isn't a bell curve, where most outcomes are clustered in the middle. It's a power law curve, where a tiny number of successes account for almost all of the gains. Excel Partners, a famous VC firm, invested early in a little company called Facebook. That single investment returned their entire fund many, many times over. What happened to the other companies in that fund? It almost doesn't matter. The Facebook investment was the Babe Ruth that won the entire World Series. This power law dynamic creates a very specific mindset in a venture capitalist. It explains almost all of their seemingly strange behavior. They aren't trying to avoid failure. Failure is a given. They are trying to find the one outlier that can change the world. This means they have to say no almost all the time. But the most painful no isn't investing in a company that fails. The most painful, career-ending mistake a VC can make is a sin of omission: passing on the next Google. Missing that one home run is far worse than striking out 10 times. So, when you, the entrepreneur, walk into that room, the VC is listening for one thing above all else. They are asking themselves a silent question: does this have the potential to be a home run? Can this company become so massive that it returns my entire fund? If the answer isn't a clear maybe, the conversation is already over. This is why VCs will often pass on perfectly good businesses: a local restaurant chain, a successful consulting firm, that could make their founders very wealthy. Those are great businesses, but they are not venture-scale businesses. They don't fit the power law model. They are singles in a game where only home runs count. This leads us to the 3 fundamental questions every VC is trying to answer when they evaluate a new company. Scott Kupor breaks it down into people, product, and market. Let's start with the one that VCs obsess over the most: market. The mantra on Sand Hill Road isn't location, location, location. It's market size, market size, market size. A great team in a bad market will always lose. But a mediocre team in a great market can still succeed. The market is the wave, and the startup is the surfer. A world-class surfer can't do much on a tiny ripple. But an average surfer can ride a tidal wave a very long way. So, how do you show a VC that you're surfing a tidal wave? Sometimes, the market is obvious. If you're creating a new database technology to compete with Oracle, everyone knows that's a gigantic market. The question then becomes about your product and team. But the most exciting opportunities often create markets that don't exist yet, or radically expand small ones. When Lyft and Uber started, many investors looked at the existing taxi market and thought, it's a decent size, but not huge. They missed the point. The founders argued that with the convenience of a smartphone, the market wasn't just taxis, it was every car trip. They weren't just replacing taxis, they were creating a world where people might not need to own a car at all. That was a tidal wave. Similarly, when Airbnb first started, the idea was about renting out air mattresses on your floor. An investor could have easily looked at that and said, the market for people who want to sleep on a stranger's floor is pretty small, but the founders saw a bigger picture. They were tapping into the entire global travel and hospitality market, and even expanding it by making travel more affordable and accessible. Your job as an entrepreneur isn't just to describe the market as it is today. It's to paint a picture of what the world will look like once your company succeeds, and why that world represents a massive opportunity. But even with a giant market, the VC still needs to believe that you are the one to capture it. This brings us to the second pillar: people. Since most early-stage startups have no revenue and barely a product, the VC is fundamentally betting on the founder. They are looking for something called founder market fit. What is it about your life experience, your skills, or your unique obsession that makes you the perfect person to solve this specific problem? Martin Casado, the founder of a company called Nicira, is a perfect example. He had spent his early career at the CIA working on the very technology he was now building, and then went on to get his PhD at Stanford in the exact same field. His entire professional life had been a training ground for this one company. He had an almost unfair advantage. That's founder market fit. The founders of Okta, a software security company, had both come from Salesforce. They had lived and breathed the problem their company was trying to solve. They had seen it from the inside and knew exactly what customers needed. But it's not always about deep expertise. Sometimes, being an outsider is the advantage. Herb Kelleher, the co-founder of Southwest Airlines, was a lawyer. He once quipped, "I knew nothing about airlines, which I think made me eminently qualified to start one." His ignorance of the rules of the airline industry allowed him to break them and create something entirely new. Beyond your background, VCs are looking for a unique kind of leadership. Ben Horowitz and Mark Andreessen used to call it egomaniacal, though they later softened the term. It's a deep, almost delusional self-belief that allows a founder to persevere when everyone else says their idea is crazy. Great ideas often look like bad ideas at first. A VC's job is to find the good ideas that look like bad ideas. And it takes a special kind of person to chase those. Finally, we get to the product. You might think this would be the most important part, but in the early days, it's often the most flexible. VCs assume that the product you pitch them is not the product that will ultimately make the company successful. What they are really evaluating is your idea maze. How did you arrive at this solution? What paths did you explore and discard? This shows them how you think. They are looking for founders who have strong opinions, but are weakly held. This means you have conviction, but you're also willing to listen to the market and adapt, or, in Silicon Valley parlance, pivot. Stuart Butterfield started a gaming company called Tiny Speck. The game was beautiful, but it wasn't a sustainable business. With only a few months of cash left, he went to his board. He told them that in the process of building the game, his team had created an internal communication tool that had made them incredibly efficient. He asked for permission to use the remaining money to turn that internal tool into a new product. The board said yes. That tool is now known as Slack, a company valued at many billions of dollars. That is the power of a pivot, and it's why VCs bet on the founder's mind more than their initial product plan. So you've navigated the maze. You've convinced a VC that you're chasing a massive market, that you are the perfect person to do it, and that you have a thoughtful approach to building your product. They're excited. They say, "We'd like to offer you a term sheet." This is a moment of pure celebration. But it's also where the real game begins. The term sheet is the rulebook for your partnership, a document that will define your relationship for the next 10 years or more. And this is where the information asymmetry is most dangerous. The VC has negotiated hundreds of these. For the founder, it might be their first. Scott Kupor dedicates a huge portion of his book to demystifying this document, breaking it down into two main buckets: economics, how the money works, and governance, who has control. Let's start with economics. The first number everyone looks at is the valuation. A VC offers to invest $10 million at a $50 million post-money valuation. What does that mean? Post-money means the value of the company after the investment goes in. So, if the post-money is $50 million and the investment is $10 million, the pre-money valuation, the value before the investment, was $40 million. The VC's $10 million investment buys them 20% of the company. $10 million is 20% of $50 million. Now, you might think your goal is to get the highest valuation possible. More money for less of your company. It seems simple. But this is one of the book's most crucial and counterintuitive lessons. A too high valuation can be a trap. Remember, you're not just raising money once. Most startups raise multiple rounds. Let's say you raise your Series A at a very high valuation. You've set the bar incredibly high. For your next round, the Series B, new investors will expect you to have made monumental progress to justify an even higher valuation. If you only double the business when they expected you to triple it, you might face a down round, raising money at a lower valuation than before. A down round is more than just a financial hit. It's a signal to the market, and to your employees, that the company is losing momentum. It can create a death spiral of morale and confidence. It's often better to raise money at a fair, achievable valuation that allows you to create a steady, upward trajectory, the classic up and to the right graph that keeps everyone motivated. But valuation is just the beginning. The real secrets are buried deeper in the term sheet. The most important of these is the liquidation preference. This is the term that protects the VC's investment. In its most common form, a 1x non-participating preference, it means that if the company is sold, the VCs get their money back first, before anyone else, before the founders, before the employees. Let's say a VC invests $10 million. If the company is sold a year later for $40 million, the VC has a choice. They can either take their $10 million back, the 1x preference, leaving $30 million for everyone else. Or, they can convert their preferred shares to common shares and take their 20% ownership of the $40 million, which would only be $8 million. Naturally, they'll take the $10 million. This seems fair, a way for investors to protect their downside. But it creates a fundamental conflict of interest, which became famously clear in a legal case involving a company called Trados. Trados raised nearly $58 million from VCs over its lifetime. But the business struggled, and the board decided to sell. They got an offer for $60 million. With a $58 million liquidation preference, the VCs stood to get almost all of their money back. The common shareholders, the founders and employees, would be left with just $2 million to split among themselves. But it gets worse. The board also created a management incentive plan, or MIP, to reward key executives for getting the deal done. This MIP was worth about $8 million. So, when the deal closed, the VCs agreed to take a little less, about $52 million. The executives got their $8 million. And the common shareholders? They got zero. A shareholder sued, and the case went to court. The court's analysis revealed the harsh reality of the dual fiduciary problem. As board members, the VCs had a legal duty to act in the best interest of the common shareholders. But as investors, their own financial incentive, driven by the liquidation preference, was to get their money back, even if it meant the common shareholders got nothing. The court found them to be conflicted. The Trados case is a cautionary tale that every entrepreneur needs to understand. The terms in the term sheet aren't just legal jargon, they create real-world incentives that can dramatically change the outcome for you and your team. This brings us to governance, the second bucket of the term sheet. This is all about control. Who gets to make the big decisions? The most important battleground here is the board of directors. The board has the ultimate power. They can hire and, most importantly, fire the CEO. A typical early-stage board might have 3 seats, one for the founders, the common seat, one for the lead VC investor, the preferred seat, and one for an independent neutral director. This is a balanced board. However, in recent years, some founders have fought for founder-controlled or common-controlled boards, where the common shareholders have a majority of the seats. This effectively means the founder cannot be fired without their own consent. Travis Kalanick, the founder of Uber, famously had this kind of control, which made it incredibly difficult for the board to remove him even amidst widespread controversy. Conversely, a VC-controlled board gives the investors the power to replace the CEO if they feel the company is heading in the wrong direction. There is no single right answer here. It's a negotiation, a balance of trust and power. But understanding what's at stake, control over your own company, is critical. The term sheet also contains protective provisions. These are a list of actions the company cannot take without the explicit approval of the preferred shareholders, the VCs. This can include selling the company, taking on debt, or even changing the size of the board. It's another layer of control, a set of checks and balances on the CEO's power. Navigating this complex web of economics and governance is like playing a high-stakes game of chess. But Scott Kupor's message is that it doesn't have to be an adversarial battle. The goal is to create a structure that aligns everyone's interests. When VCs and entrepreneurs are aligned, magic can happen. When their interests diverge, it can tear a company apart. The journey doesn't end with the term sheet. As the company grows, it will face new challenges. It might need to raise more money. And as we've seen, this can sometimes be a difficult financing, a down round, or a recapitalization. These are painful moments, but often necessary to reset the company for future success. It requires honesty, transparency, and a deep trust between the founders and their investors. And then comes the endgame, the exit. For most venture-backed companies, this happens in one of 2 ways: an acquisition or an initial public offering (IPO). An acquisition is when a larger company buys your startup. Sometimes this is a wonderful outcome, a way to bring your product to a much larger audience. Other times, it's a disappointing end to the dream of building a standalone company. More than 80% of VC-backed exits are acquisitions. The IPO is the holy grail for many. It's the moment the company goes public, selling its shares on a stock exchange like the Nasdaq. For the VCs, this is their exit. It's the moment they can finally sell their shares and return that massive profit to their LPs, the university endowments and pension funds who trusted them years ago. But what's surprising is that the number of IPOs has been declining for years. Companies are staying private longer. Why? Because there is now a flood of private capital available from sources beyond traditional VCs. Mutual funds, sovereign wealth funds, and hedge funds are all investing in late-stage private companies. A company like Uber could raise billions of dollars without ever needing to go public. This has a profound effect on the entire ecosystem. It means more of the value creation is happening in the private markets, captured by a small group of investors, rather than in the public markets where everyday retail investors can participate. When Microsoft went public in 1986, it was valued at around $350 million. Today, its market cap is in the trillions. The public market investors who bought the stock at the IPO and held on have seen a mind-boggling return. In contrast, when Facebook went public, its valuation was already $100 billion. It has grown tremendously since then, but a huge portion of its value creation had already happened while it was private. This shift underscores the changing landscape of venture capital. The world is getting flatter. Capital is no longer the scarce resource it once was. 20 years ago, the U.S. accounted for 90% of all global venture capital. Today, that number is closer to 50%. This is the final, and perhaps most optimistic, secret of Sand Hill Road. The game is changing. Access to capital alone is no longer enough to differentiate a VC firm. The best firms, as Scott Kupor and his partners at Andreessen Horowitz envisioned, now compete on the value they provide beyond the check. They act as a network, connecting their companies with talent, customers, and expertise. They are true partners in the company building process. The old world of venture capital was a kingdom where a few gatekeepers on a single street held all the keys. The new world is a global, democratized ecosystem where the best ideas and the best partners will win. The secrets are out. Commentary. So, what do we take away from all this? As I've spent time with Scott Kupor's work, a few core ideas have really stayed with me, lessons that apply far beyond the world of venture capital. The first, and most powerful, is the idea of understanding incentives. Secrets of Sand Hill Road is, at its heart, a book about why people do what they do. Why does a VC behave in a certain way? Because their LPs have given them a very specific mission. Why does a founder fight so hard for control? Because it's their dream on the line. Once you understand the underlying incentives of everyone at the table, their actions are no longer mysterious. They become predictable. This is a superpower in life. Whether you're in a job interview, negotiating a contract, or even just working on a group project, take a moment to step back and ask, what does the other person really want? What are their constraints? What does success look like from their point of view? When you can answer those questions, you move from playing checkers to playing chess. You start to see the whole board. The second lesson is the profound importance of market size. A great team in a bad market will always lose. This is such a simple but brutal truth. So often, we fall in love with our idea, our product, our solution. We become convinced of its brilliance. But we fail to ask the most important question: is there a tidal wave here? Is there a massive, structural shift happening in the world that our idea can ride? Don't just look for a problem to solve, look for a wave to catch. The best surfers don't create the waves, they just have the wisdom to see them coming and the skill to ride them. And finally, the book is a masterclass in the art of storytelling. When an entrepreneur pitches a VC, they have no revenue, no profits, and barely a product. All they have is a story. A story about what the future could look like. A story about why they are the one to build it. That story has to be so compelling that it convinces people to quit their stable jobs, to invest millions of dollars, and to dedicate years of their lives to an idea that will probably fail. We are all storytellers. We tell a story to a potential employer about who we are. We tell a story to a university about our ambitions. We tell a story to ourselves about the person we want to become. This book reminds us that the quality of that story, its clarity, its conviction, its authenticity, can change everything. So, how can you apply this today? First, start thinking in terms of founder-market fit for your own life. What is the unique intersection of your skills, your passions, and your experiences? What problem in the world are you uniquely suited to solve? It doesn't have to be a billion-dollar company. It could be a problem in your community, in your school, or in your own habits. Find your fit. Second, practice understanding incentives. The next time you find yourself in a disagreement or a negotiation, stop defending your position and start trying to understand the other person's. What is their power law? What is their home run? You'll be amazed at how it changes the conversation. This journey through Secrets of Sand Hill Road has been about pulling back the curtain on a world that seems impossibly complex. But at its core, it's about something very human, a partnership between people with a bold vision and the people who believe in them enough to fund the voyage. It's a story of risk, of failure, and of the rare, spectacular successes that change the world. That was a summary of Secrets of Sand Hill Road by Scott Kupor. We've covered the highlights today, but I'll be honest with you, a summary can only ever be a map. The real treasure is found when you make the journey yourself. The true value of a book like this isn't just in the facts and figures, it's in the way the stories and lessons connect with your own experiences, sparking new ideas and new ways of seeing the world. This summary is your starting point, a way to see if this is a journey you want to take. If anything we've discussed today has sparked your curiosity, I encourage you to pick up a copy. Reading it isn't just about learning, it's about equipping yourself with the knowledge to navigate the modern world of innovation. You'll find a link to the book in the description below. Also, if you've found this journey valuable, please take a moment to click that subscribe button and give us a like. It truly helps us bring these ideas to more people. We're building a community of curious minds here, and I'd be honored if you'd join us for our next exploration into another life-changing book from the billionaire's bookshelf. Let's keep growing together.